Hello, everybody. Welcome to the channel. Today, we're going to do a deep dive on CLO and CLO equity using some closed-end funds, EIC, ECC, OXLC, and X. And we're going to really focus on CLO equity, which is providing a unique opportunity right now for very high dividends and very low risk. Our disclaimer, this video is for educational and entertainment purposes only. I'm not a financial advisor and nothing in this content should be construed as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, including buying or selling any securities. Before we get into the funds, let's look at the overall macro regime. So as of the spring pre-market on the November 17th, Monday, market remains intact. We had a test of the trend line again in the 50-day moving average on Friday, closed up, which often happens on Friday afternoons. Just to a good chance here, we're going to rally back up to the top end of this range. I don't necessarily think that we're going to get back to all-time highs here. We do have a sell signal, and you can see here the sell signal has continued for the last week or so. And also the global regime tracker. This is where I'm looking at reflation using multiple signals from across the world. This does look to be improving. So we could see kind of the general global economy accelerating, and if so, that could allow U.S. stocks to continue rallying. But we do have kind of this topping formation here, starting to look like it wants to turn down, but keeping an eye on it, because if the green bars start accelerating up, then that's a pretty big signal, I think. Looking at gold, we just had a great rally this year, correction, and then a test. Looks like we only got to the 50% or just a 0.61 retracement of the correction, and now we're starting to show the second leg down. I do think this is still a buy on dip opportunity, but I could see us getting down here to 37.70, and yeah, good chance of it stabilizing or at least testing a third time to see if we can get back into an uptrend, or this could turn into like a flag kind of pattern, and it could last several months, into early next year as well. I do feel like this consolidation will be a good buy on dip. I'm still bullish. I don't expect it to jump immediately back up to all-time highs. Oil, we are, as previously mentioned, we're in a 3-year range, and we're kind of at the lower end of the range right now. Nothing much has changed. I did want to highlight, we did see the buy signals here, which we were looking for after a long downtrend. We did see the buy signals, but they've turned to sell signals. So to see how this plays out in the next few days, could also have geopolitical events triggering buy. That would be something probably related to Venezuela. Bitcoin is in a pretty bad downtrend. We did hit the Fibonacci 0.61 right on the mark there, and this morning we're still hovering in that same range around 94,200. We should bounce from here. I'm still long-term bullish. Again, I was looking for this pattern that happened in the last correction where it hit exactly that 0.618. It's done that again and stabilized, reversed back up, but we are still in a sell signal, and so it could fail here. Look at the Monday morning should be should probably work out. We'll see how it plays out in the next few days. All right, let's dive into our content for this week. We're going to focus on CLOs and CLO equity. And I'm about to collect a bunch of research, and for timing, the Urban Cowboy had an interview, and he wrote a great substack. So we're going to dig right into Michael Kao's substack in order to get a lot of this information. I will include the link to the substack in the notes under the video for your link for yourself. But for Cowboy Musings, Michael Kao, he's he's got a long career and a lot of experience with these kinds of markets. So first up, you have to listen to his interview. It's 48 minutes. It's extremely jam-packed with very complex content. And the notes here but on the Substack help to explain some of what was discussed in the interview. So I would say read the Substack and listen to the interview. Basically, just wanted to, we'll go through this roughly here. CLOs are basically collateralized loan obligations. So what they do is they take broad securitization of syndicated loans. They're like senior in the corporate debt stack. So these are loans that big companies are borrowing, and they're using, and these loans get collateralized and put together into tranches. There are companies or CLO entities that own and collateral and syndicate these loans. They are like a company. They have equity. They work similar to banks. They're better than banks, is how Michael likes to describe them. And just to get a bit of an overview, the core pieces here of what we're investing in is the senior secured loans at the top of the capital stack. They're more safe than equity of the companies. They're more safe than the bonds that the companies are, the high yield bonds the companies are issuing. So these are like the top of the capital structure. They are, so the senior position, they're secured by companies' assets. So things like receivables, inventory, plants, equipment, real estate, etc. They have a floating rate, so they're not subject to major corrections when interest rates go up. There's a low loan to value, and they have a consistent returns, which we'll talk more about in another little bit later here. In fact, here we go. So this chart here describes how the leveraged loan index annual total return has only had 3 negative years. That was in 2008, 2, and 2015. You can see here that there's a good track record of these loans returning a consistent return without having major failures due to people not paying the loan. All right, so as I mentioned, the CLO equity is like a better bank. So similar to a bank, the CLO equity applies 10x leverage between loans on the loans they buy. It creates a net interest margin, and that's how they make money. And I'll let you read the rest, but unlike a bank, they don't have some of the negatives that a bank could have. There's a lot of detail here around how CLOs work. But the main point here is we have a couple of closed-end funds, as showcased here. Eagle Point Credit Company, ECC's closed-end funds buy the CLO equity. And the CLO equity owns all the CLOs. The CLOs own all the loans for all of the companies. So there are thousands of individual loans that are part of a CLO, part of a closed-end fund like ECC. And just a little bit more on ECC here, you can see in total they invest in 213 CLO equity securities, and that's managed. Each of those securities are managed by different managers. So there's 44 different managers. The underlying loans that make up the CLOs is 1,900. So it's extremely diversified, very, very spread out the risk. So if a company goes bust, you're only losing, but you can't recover in that company, and it's only a very small percentage. And right now, because of the pricing on ECC, you're making a 24% distribution rate. Again, a little bit more detail here. And let me get down to, this is just to talk that there's a lot of incorrect information out there where people think CLOs are risky because of things that have happened recently, like the Tricolor Holdings, First Brands Group, and other surprise bankruptcies. And private credit has been impacted by that. BDCs have been impacted by this, and the CLOs as well, or the CLO equity as well. And what Michael is arguing is this is incorrect information. Michael here says this is misplaced information. There's actually very little risk of the CLOs being impacted because they are repriced on the public markets on a regular basis. There is no surprise. And I think that's it. There's a lot more detail in here that you discover. And actually, he talks in this article about how BDCs are actually a bit more risky than the CLO equity. All right. So here's some of the same. Okay, and here's the main thing is ECC is currently at about a 12% discount to NAV, and you can see in its history, it's only been at a discount to NAV a few times. So it is a very unusual to see it at a discount. It's usually it trades at a premium to NAV because it's such a good security. It's stable and secure and low risk. It usually trades at a premium to NAV, and you can see here that it's at the biggest discount to NAV it's ever had since the beginning of the decade. All right, so that was specifically on ECC, the one in the middle here. And again, just to summarize, it's closed-end fund with an activist CLO equity strategy using multiple managers, etc. It has a 12% discount, and its distribution is 29%. Generally speaking, here we'll start to the far left. You can buy only the CLOs themselves, not the CLO equity. And if you wanted to do that, you can use the CLOZ ETF, which is an ETF of mezzanine CLO debt, like the BBB rated tranches. This has a very low risk. There's no equity risk and low duration because it's all fixed rate. I mean, it's all variable rate and high credit quality. Again, it's the top of the stack. 8% is the return on this ETF. Moving into the closed-end funds, we have Eagle Point Income Company. So this is again a CEF by the same company, by Eagle Point, and the closed-end fund is kind of moderate conservative. It has leverage, but it's less levered than ECC. It has a 15% discount to NAV right now, and return is 13%. OXLC is similar to ECC in that it also is a closed-end fund at a big discount and has similar risks to ECC. Michael prefers ECC because he states there's more transparency from the manager, more data is provided on a regular basis. We have XFLT, which is a combination, a hybrid. It's a closed-end fund with CLOs and senior loans. So it has some senior loans it owns directly, and it has CLOs and it has CLO equity. So about a third of it is CLO equity, and you can see we also have 13% of just pure CLO debt itself, and then 45% is a senior loan. So it's more of a hybrid approach. This one has a 14% discount and 8%. All right, so we're going to go into the next topic, which is a portfolio review. So just pull up our portfolio, and just to kind of summarize where we're at this week. Total value 137,000, total positions 127,000. I've got about 21,000 of cash, and about another 12,000 is used in margin and additional margin that I'm planning to use up to 21.7. The monthly income currently is showing as 27.27. I think it came down a little bit from last week, and that would be an annual income of about 32,000. Looking to get this up to the point where it replaces my paycheck. Some items to highlight here. So here's our CLO section. It was the least risky of the four quadrants. And here we have IC, ECC, OXLC, and XFLT. I've highlighted these because I'm planning to buy this morning. After reading Michael's article, I've become even more bullish on these. So I'm planning to set allocation to 2% for the whole grouping here. And as you can see, they are in a drawdown from previous highs, and that is mostly based on kind of this inaccurate understanding of why it should be down. So let's take a look at a chart for ECC. Oops, ECC. So you can see here how, let's even go back to 2022. So there was a downturn, a downtrend in 2022, like all risk assets. 2021, in 2020, COVID, there was a big crash and a recovery since. And here you can see we are again dipping down. These are opportunities to buy and get that high distribution rate at the purchase price. Oops, XLC. Oxford Lane has the same general pattern, but it is actually lower than it was during our earlier this year when we had the markets come down. All right, so we're buying in on those positions. No other major moves since the last video. Markets have been softer a little bit, so some of the value has come down. I think a couple $1,000. And actually, I'll highlight Winter. Winter was a purchase a couple of weeks ago to show how the bearish funds are doing. Actually, let me pull up this chart. Okay, that's frozen. All right, so here you can see, let me just go full page on this. Here you can see how Winter has done. This is where we bought it at this point, and bought it mostly because there were some buy signals here showing. And actually, this is the signal on Mr. So it was a sell signal on Mr. that triggered our interest in Winter. And the second sell signal was here. That's when we purchased. And you can see it's been doing really, really great since. This will help offset our losses on Mr. Hopefully, it's only a small position, 1.35% of the target allocation. So, we might want to continue. If the bear market for Bitcoin and Misty really develops here, we'll be going deeper into funds like Mr. All right, next week I want to start looking at, is it time to buy into the reverse NASDAQ, the reverse Tesla, the reverse NVIDIA? So that is kind of up next. In fact, we're going to call it Playing the AI Bubble Burst. We'll showcase these 4 funds by YieldMax that would allow us to be short the market and make a high income distribution at the same time. All right, thanks a lot, everyone. See you next time. Oh, please subscribe. Please like this video, and I'd love to hear your comments. I know, this is new to me. I don't have a lot of comments on the videos, but please leave your comment if you like the content. If you don't like it, let me know. Thank you.